Hey guys, Toby Mathis here. I'm one of the attorneys with Anderson Business Advisors, and I wanted to talk to you today about the best entities. Subscribe to the YouTube channel, click the bell notification icon so you know when a new video is uploaded. Tax laws are changing all the time. The laws are changing all the time. That's why you're first to know, you're first to grow. So I'm actually going to write this up. I'm not a big guy on writing, but I'm just going to say best entity for real estate. And I'm going to leave this very broad, and you'll see for why in just a second. So the first off is anytime you're investing in real estate, you're going to fall in one of two categories. You're either actively involved in real estate where you're doing things like wholesaling, I'm a real estate agent, I'm a developer, I'm a builder, things like that. Or I am a passive investor. And those of you guys who are really savvy already know you're going to say, like, hey, Toby, there's the passive activity rules where there is an exception to that, which is if you're a real estate professional. I'm not going to get into that. What I'm going to say is that there's really two big categories. And so we're just going to draw big. And one of them is active, and one of them is passive. And the easiest way to understand this is an active person. It's what you're doing. It's sweat of your brow. In other words, if I don't do anything, I don't make any money. So a real estate agent, a developer, wholesaler. So what do I say? Wholesale, agent, developer, construction, all that stuff is active business. In other words, I'm actually physically putting my labor into it, and therefore it's treated differently than if I'm over here on the passive side. And the passive side is just buy and hold real estate. So this is rentals. And it could be apartments, it could be commercial, it could be whatever. It's just, I am not doing the work. The rental is doing the work for me. So here, whether I get up in the morning and go to work or not, there's money coming in. The real estate's doing the activity for me. Now, the reason this is so important is because this one, this active right here, is subject to something called self-employment tax. So if I am a real estate agent and I'm doing it in my name, I'm going to be called what's called a sole proprietor, and I would not advise it, first off. But let's just say that I'm doing that. Then I am subject to something called old age, death, and survivors and Medicare, commonly known as the self-employment tax or Social Security, however you want to call it. It adds up to being 15.3%. There is a deduction on half of it. So the actual math is if you're under 130,000 or so, it's 14.1% that you're paying. That's a pretty big chunk. That's not talking about your income tax either, your state or your federal. That's just the extra penalty tax that does not exist over here. Now, there are some ways to avoid that over here. You could use a corporation, for example. An S or a C Corp is going to do the trick on a portion of that. Most people use S Corps because they need to live off of the money that they're earning over here, but that's not always. I'm just bringing that up because there is a way to eliminate or reduce that self-employment tax. There is no way to do it if you're just operating as a sole proprietor. So that's first off. So we can just say, don't be a sole proprietor. You always want to make sure that you're structured in some taxable entity whenever you're involved in active businesses. Now, the passive side's a little bit different because passive, I'm just going to put a big plus next to it. You get all sorts of benefits from passive activities. First off, there is no self-employment. There is also something called a 1031 exchange where you can trade the money, trade the assets for more assets, and you don't actually have to pay tax on it. That's called a deferred exchange. So, you know, in theory, you pay it eventually, but if you never sell the asset, you keep it till your dying day. The basis steps up. You can literally avoid paying tax through this. You also have depreciation. You have the ability to do installment sales. There's all sorts of stuff, installment. Heck, I can even do cost seg. I mean, there's so many benefits that here, I'm writing off the board, so I'm going to call it a cost seg. There's so many benefits there that I can actually utilize by being a passive entity. Now, here's why this is really important. Because when you're choosing the type of entity, when you pick an entity, you don't want to destroy those advantages if you can avoid it. And there are certain types of entities that you can use The most commonly used one is going to be an LLC, and that LLC is going to be taxed either as a disregarded entity if it's just you, or it's going to be taxed as a partnership. You're probably not going to be looking at any other options other than that. In fact, I can pretty much tell you that for real estate investors, we're almost always going to an LLC. Now, some of you guys are big land trust buffs, and I get it. That by itself doesn't provide you any asset protection. And so I'm going to kind of go over these three categories that you look at whenever you're doing an entity. Whenever you do an entity, I'm going to be looking at the state. I'm going to be looking at third parties, and I'm going to be looking at the IRS. And I'm just going to put those into categories. And this is actually, like, if you break it down in any practitioner, whether you're a lawyer, an accountant, or anybody else, go ahead and steal this, because this is the easiest way to understand it. In a state, I could have something called an LLC. And I'm not going to jump into series LLCs. I'm not going to jump into, but from a state level, I just care that I have a vehicle that isolates the liability. And so what I care about is putting a box around whatever the liability is. If I am a plumber and I want to make sure I never get sued in case something happens on a job that I work on, maybe I break a pipe in somebody's house, I need to operate through, you got it, an entity. If I have real estate, I want to make sure that if a tenant falls down the stairs, it doesn't cost me everything else I own. So that's called inside liability. It stays inside this little guy. The state is who you pay to get that benefit. So I'm actually paying the state and saying, please give me some benefits in the state. And again, we have 50, so we can choose, right? But wherever the real estate is held is more than likely that's where I'm going to be sticking my entity for holding this thing. But that state, I'm paying them money, and they're saying, here's benefits of a statute that you can now use to your benefit that's going to keep the liability inside that thing. But there's also me. I'm sitting out here. That's called outside liability, and that's also important. When we develop an asset protection plan at some point, we want to make sure that somebody cannot, hey, I, or maybe it's one of my kids or something, gets into a car accident, and all of a sudden I'm looking at getting everything I own taken away, whether or not they can take away that LLC. And there are states where they cannot take it away. And so we usually are putting our real estate in here, but we may put another box around even the real estate hold, like we call it a holding company, and it would hold all of my other LLCs. But for now, I'm just going to focus on the fact that we can create a box. We can put our real estate in that box, and that's where the liability stands. Then we have third parties we have to deal with, and this is your judges, lenders, your bankers, your hard money lenders. All those things fall into this category. Any shareholders that I'm dealing with or other members in my LLC, this is where I am going to have a contract. I need to make sure that I'm doing this part right, and this is where people usually goof up, by the way. It's in that operating agreement or other agreements. So if you can read my writing, just call that an operating agreement or OA. If I'm dealing with a lender, they're going to want to see that. If I am just, hey, maybe I buy a property and then I put it into the box, maybe there's no lender that's actually seeing that. If I do that, I may use one of your land trusts. Again, those land trust buffs out there, land trust does not provide asset protection. It just is a good thing for disguising title. So we're just looking at the third parties there. That's our operating agreement, and that's the body of it. So if you kind of think of like this, if I don't do this and I don't do this, it flows through to me. So it's my body. They can attack my assets. It's really just me. If I do this without doing this, so if I actually file with the state, but it doesn't have a body, it's going to defer to the statute, which is going to flow down to me. So I need to make sure I'm doing both of these. And then this last category is the most important, and this is where people screw up. I could be a sole proprietor. I could be a partnership. I could be disregarded. I could be an S Corp. I could be a C Corp. I could be any of those things. An LLC is not a tax designation. So if you ever hear people say, hey, how are you set up? And you say, well, I'm an LLC. Well, how are you taxed? And if they say an LLC, you can make fun of them. Now you just say, hey, there's no such thing as an LLC tax as an LLC. You have to tell the federal government. You have to tell the IRS, what is it? Should we ignore it and just look at your return? Hey, it's going on my 1040 Schedule E. Is it, hey, it's going to be treated as an S Corp? Okay, then it's going to go on an 1120S. hey, should we treat it as a C Corp? Okay, then it's going to go on 1120. Is it going to be taxed as a partnership? Great, it's going to be a Form 1065. So all of those things we're looking at. And by the way, some of you guys are, again, I know there's some tax nerds out there. They're going, hey, what if a corporation owns an LLC that's disregarded? Yeah, then it goes on the corporate return. All right, but the point is that the IRS needs to be told how to treat it. Now, if we have real estate, and it's this type of real estate, then we're going to put it in an LLC with an operating agreement that is more than likely disregarded or taxed as a partnership, because those two things keep all of these benefits. Whereas if we put it in one of these, we could lose it. We probably aren't going to be an S or a C Corp for purposes of investment property. We're going to be an S or a C Corp only if we're on the active side. And if we're on the active side, then we want to make sure that we're keeping it off of our tax return to avoid the self-employment tax automatically. Like, we could still have an S Corp flow onto my return. I could still take a portion of that as salary and pay a little bit of Social Security, but on everything else, on all the distributions out of that, above that amount, I avoid it. And it saves you, in my experience, I have 20-something years of experience in this, it's about somewhere between 10 and 15% a year on how much it's making. So there's a pretty big spread when you're looking at the typical case of somebody who's running their real estate agent, who's a wholesaler, who's a developer or construction company. You're usually going to be setting that up. Again, our default's probably going to be an S Corp. And then maybe sometimes we look at a C Corp and maybe we layer it. Sometimes you're looking at it saying, hey, could I actually use 2 or 3 different entities? Yes, you can. And it has to make sense. This has to make economic sense. So getting back to the original question, which is the best entity for real estate investors. Here, I'll get rid of that little line. Our actual answer. So if you're a real estate investor or you're an active real estate person who's a wholesaler, an agent or something, it's more than likely it's going to be an LLC. And then you choose how it's going to be taxed and you make sure that you document that appropriately. I hope this helps you make better decisions. If you need help on this, obviously give us a call. This is something we specialize in, and we love working with real estate investors and people that flip, wholesalers, agents, you name it. We're used to dealing with it, and we're used to compartmentalizing certain types of risk. You just use the little boxes, and it's kind of like magic. You get the benefits, you pay the state, and you say, all right, what are the benefits I can get? But somebody who's working with you needs to be experienced in real estate, needs to be looking at these things, be able to articulate the difference so that you don't walk into a problem by sticking this in the wrong business or taking a rental and losing benefits. Again, if I ever see another rental property stockpile of properties where somebody's investing and they're all sitting in a corporation, I have to explain to them when they take it out, it's treated as wages. You know, it's like, whoa, you transfer that asset out, you're going to get nailed. You know, you're going to basically have to hold that until you pass away, and then the basis can step up. We can remove it. But it's a pretty big negative. If I see that again, I'm just going to go crazy. I'm going to say, obviously, you're not watching our videos, but that's not going to be you because here you are watching this video. But hopefully we could help you. If you have questions, give us a call. Again, my name's Toby Mathis, and it's always fun to try to figure out what's the best entity for real estate.